Hello, I'm Michael Bender, one of the principals of Bender Commercial Real Estate Services. My partners and I are pleased to present our 18th annual Market Outlook. As you listen, I hope this information will be helpful to you and with your business decisions in 2015. To begin the presentation, I will detail the economic conditions that influence the national and global markets. That will lead into an analysis of our community's economic health. Rob Fagnan will follow me with a look at land sales over the past year. Then Reggie Kuipers will inform you of the emerging trends in the exciting world of retail. Our office market specialist, Andy Anderson, will report on the downtown and suburban office markets. Nick Gustafson will follow, describing the investment market and commercial sales. Finally, Doug Brockhouse will discuss the past year in industrial market and what to expect in the future. Thanks for listening and have a great 2015. Let's start with the global instability out there. China is slowing down, coming off of GDP growth of 10 to 12% the last several years, now to only 4 to 5, maybe 6%. That, of course, would be the envy of any other industrialized nation. But nonetheless, that slowdown is having ripple effects throughout the global economy. You can only look to oil to see those effects and what's happening. Another area of big concern is European zone. Very shaky right now. Greece is starting to fall apart with the new leftist government just coming in. The austerity programs there will probably be demolished, and you're going to see, no question, Southern Europe countries like Portugal, Spain, Italy follow Greece's lead. I'd like to end also with a discussion about Russia, the Great Bear. Who knows what the Great Bear will do when backed into a corner? 45% of their federal revenue comes from petroleum revenue. So who knows what's going to happen there as well. And finally, I want to get you thinking about the black swan theory, which is a popular theory recently unveiled by a book from a Wall Street trader. And what it really talks about is random and unexpected events that are difficult to predict when they happen. But when they happen, they have a wide-ranging impact on the world. Well, after such gloomy news on the global front, let's turn our attention to the U.S. economy. You can see the next slide shows the strengthening of the dollar. The dollar index, which tracks the dollar against 6 major foreign currencies, is up 15% since last June. Why is that? Well, first, our economy is just getting stronger, no question about it. And as our economy gets stronger, you'll see foreign money begin to invest more and more in our currency and in our bonds, and as a result, they're going to follow the federal rates going up, and no question the dollar will continue to get stronger as that happens. I'd also like to turn your attention to our federal deficit. Since 2009, you can see a dramatic decrease in their federal deficit. In fact, at this point, it's ranging about 3% of our GDP, which is about a 40-year average. More good news is the drop in the price of oil to the American consumer. In fact, the average American spends 7.4% of their annual expenses on transportation. So you can see how this drop will have a dramatic impact on the American consumer. It's estimated that if the price of crude remains around the $40 to $50, maybe even $60 per barrel, the savings to the American public will be $240 to $250 billion in a one-year time frame. Turning our attention to jobs, there's another good sign of the strengthening economy. This slide shows that our economy grew jobs at a 2.1% growth last year. That's the highest it's been in the last 10 years. That's great news. Let's also look at job growth in terms of not only the national but the local perspective. The yellow line represents the Sioux Falls economy, which added jobs at about 1.2% last year. And the South Dakota economy is represented by the purple bar, which added jobs at only 0.8%. So you can see the national economy is very strong right now. But there's a silver lining in these numbers. We are adding jobs, but what kind of jobs are they? Well, not all these new jobs are part-time. A good number of them are part-time and further exacerbate a growing problem of income equality or wage stagnation. I like this chart because it shows the relationship between the productivity of workers over a long period of time and the compensation. At the risk of sounding too dramatic or overstating this issue, I believe wage stagnation will, if not successfully addressed at the national level, become one of the defining issues over the next 25 to 30 years that could lead to a direct threat to our republic. Are we having the same issues with wage stagnation and income inequality right here in Sioux Falls? Well, let's look at this next two charts to see. This is a different way of looking at it. It's called personal income, and it does include a few more things other than just pure wages. But nonetheless, you can see the U.S. personal income growth, which topped out at about 2% last year. Well, if you count inflation, really that was only about a 1% growth in the personal income for most Americans. Now let's look at Sioux Falls and the South Dakota economy in personal income growth. The yellow line represents Sioux Falls, which topped out at about 3.5% last year, while the South Dakota economy topped out at about 2.4%. Why is that South Dakota and Sioux Falls in particular outpaced the U.S. economy? Well, I believe it's programs like Governor Dugard's new job training program, and certainly at a local level, Forward Sioux Falls has had a long track record of growing not only jobs, but growing good paying jobs for our community. Some other solutions for eliminating this wage stagnation issue: certainly restore full employment. That's easier said than done, of course. Another one would be to not raise interest rates until the wage growth has improved dramatically. Public investment is always a good way of creating jobs and future productivity growth. While we haven't seen much success of that at the national level, certainly here in Sioux Falls we've seen some good examples of that, most recently with our event center. Now let's turn our attention to the Sioux Falls MSA employment. If you recall, we showed you a chart that showed employment growth in terms of percentages, which was 1.2% for the Sioux Falls metro area. This shows the raw data now. 1,800 new jobs were added last year to our economy. We like to look at the job growth first because it always gives us a good predictor as to what our building permits will do. This chart shows you we had a record year last year of $619 million in total construction for Sioux Falls area. The interesting thing to note here is residential, represented in the purple bar, outpaced commercial for the first time in a number of years. Yes, $619 million last year in total permits was a record. But the naysayers out there reminded us that we had a hail storm that created a lot of damage. So we wanted to take out the total dollar amount of that hail damage, and you can see with 70 million less, it still was a very significant year. In fact, the second largest year for construction on record. Turning our attention to the regional comparisons, you can see Sioux Falls still maintained strong growth amongst our peers. Omaha outpaced us with 697 million, no doubt a much bigger community. The one to note is Fargo, with over $1 billion in new construction permits last year. That was primarily due to a $400 million new hospital that's being built in Fargo. Now turning our attention to new commercial construction in Sioux Falls, which totaled about $86 million last year, you can see the different categories represented by the various bars. The one interesting thing to note is retail, which was down last year, should make a dramatic increase this year. Some examples of the larger commercial construction last year, both new construction and addition remodel. Finally, turning our attentions to predictions for 2015. I don't think I'm brave enough to make predictions on a global basis, but I will make some predictions for the Sioux Falls outlook. Job growth should remain steady, around 1,800 to 2,000 jobs this year. Look for most of those jobs to be in the retail and the medical corridor. Certainly medical will be the IT area. Construction, retail, as you've heard, will be up. Office should be pretty stable. And I do believe industrial construction will be up again this year. Residential construction, single family will be stable. And I do believe multifamily construction will be down after a large amount of new construction in 2014.
All right, well, for this year's land market report, I'm going to be highlighting some trends that took place in both the unimproved and improved land markets. If you've heard our presentation in the past, please bear with me on this next slide as I take a moment to define what I mean by the land market. By our definition, the land sales market consists of 5 different property types. It all starts out as unimproved land, which is generally the farm ground that surrounds the city, and is sold on a per acre basis. Now when you add in all the services such as curb, gutter, sewer, water, etc., it becomes improved ground, which is used for the 4 other basic property types. These are all sold on a per square foot basis. So to start out, let's take a moment and look at my report card from last year. I had predicted we would see an increase in unimproved land sales, that improved land sales would remain steady, and pricing would increase in all sectors of the market. Let's take a look at how I did. We'll start out with the unimproved land market. Instead of going up like I had predicted, the number of transactions in 2014 actually dropped to 5. However, I wouldn't be too concerned about this drop. It's still the second highest number of transactions the market has seen since pre-recession levels. Now, of those 5 transactions that occurred last year, all but one were for residential developments, selling between $26,000 and $59,000 an acre. The 5th sale was a second-generation mixed-use development that sold for $55,000 an acre. It's important to note that all of the 2014, 2013, and 2012 sales were on the south and east part of town. This makes it pretty obvious that developers are positioning themselves for the next 5 to 10 years of growth. So to properly gauge the health of the unimproved land market, we have to take a look at one of its major driving forces, the residential market, and its availability of build-ready lots. What do I mean by build-ready lots? I'll make it simple. Buy a lot tomorrow and go build on it the very next day. So in 2014, Sioux Falls had a supply of just under 3,000 build-ready lots by year's end. Now when you compare the approximate 3,000 available lots, the yellow bar, to the 835 building permits, the blue bar, that were issued last year, we're sitting on about a 3.5-year supply. Now because we've had so many unimproved land sales these past 3 years, I'm expecting that yellow bar to start increasing as developers add infrastructure to all the unimproved land they've been buying up. Now let's shift gears and talk about that per square foot stuff. For 2014, the total number of transactions increased by 15%, from 54 to 62, which equated to just under 30 million in sales. Now, even though the number of transactions increased, the total volume took about a $9 million hit. Why is this? Well, we didn't have as many retailers out there buying up all that high-priced land, which is clearly shown on the following slide. The number of transactions in the retail land market, the green bar, dropped about 30%. However, it still came out on top. If you happened to hear this presentation last year, I had predicted we would see this drop, as construction would try to catch up with all those 2013 acquisitions. And to no surprise, the industrial land market, the yellow bar, has remained in the number 1 or 2 position for 8 years running. So let's take a look at the going price for these various land uses. The largest spread when it comes to pricing is in the office and retail markets. They're much more location sensitive than that in the industrial and multifamily markets, which in turn drives up the price. A great example of this is the purchase of infill sites. These are generally those sites where the land is more valuable than the existing structure. Typically, an investor or owner-occupant will purchase these properties with the intent of redeveloping a site for a higher and better use. These types of properties bring a higher price per square foot than all the other sectors of the market, between $15 and $35 a square foot. Some examples this past year include the old Hoy Law Office and bank site, which will house a mixed-use development. Another was an old house that got converted to a parking lot along Minnesota Avenue. And the last example is downtown across the street from Sunshine Foods, which is in the process of being converted to residential condos. Let's jump right into my conclusions and predictions. As for unimproved land sales, with a fairly limited supply of build-ready lots, expect developers to step out and buy up some additional land, around another 5 land tracts. As for unimproved land sales, for the past 4 years, this market has seen 15 to 40% increases in the number of transactions each year. And I believe we'll see another record high for 2015, around 65 to 70 transactions. Also, keep your eye out for a third straight year of infill site purchases. As for pricing, the price per acre and the price per square foot that people are paying continue to go up. Watch this upward trend to continue throughout the remainder of 2015.
2014 was a year of growth in the retail sector. We saw rising rental rates, decrease in vacancy, quicker deal acceleration, a massive amount of new sale transaction, which Nick will talk about later. With all that going on, the one surprise we did see was a little less new construction than expected, but we'll touch on that a little later. Retail tends to focus in clusters, generally around a landmark like the Empire Mall or along a heavily trafficked intersection. In the past, we've broken each of these focal points down individually and presented on them. But when we took a look at the numbers this year, we realized it was pretty much status quo. So instead, my report is going to focus on some of the trends going on in the retail market. But we still have the data, and let's take a look at it here. A couple of interesting notes on this slide. Let's take a look at 26 and Marion. We saw a spike in vacancy up to 17.5% this year, which was primarily caused by new construction and retail strip mall development in Lake Lorraine. A few of the tenants occupying space there were cannibalized from that existing intersection, which further peaked that vacancy. I would look for that trend to decline in 2015. Also, let's take a look at Dolly Farm area, which does include the retail space on the north side of Arrowhead. For years we've been in the mid-teens. For the first time, we're down into single digits at 9%. As I previously stated, my presentation is going to focus a little bit more on trends. And one of those trends is restaurants. I know that this may look like the Sprint cell coverage map in the United States, but it's actually a restaurant densification map per 10,000 households. Certainly the urban legend in Sioux Falls is that we have more restaurants per capita as anywhere in the country, but as you can see on this map, that's not quite the case, which simply means there's room for growth, which is exactly what we saw in 2014. Take a drive down East 10th Street with me. In the last 12 to 18 months, we've seen the following new restaurants: Pita Pit, Qdoba, Pizza Man, Macho Nacho, Lick the Spoon, Jimmy John's, Firehouse Subs, Noodles, Panera, Panda Express. We saw a huge expansion in the last 12 to 18 months. Also, we've recently heard discussion of a restaurant row in Sioux Falls. Based upon conversations we've had with national restaurant chains, that is a possibility. However, It's more than likely going to happen at a destination like Lake Lorraine versus anywhere else in the city. Also, another interesting thing to watch going forward will be the minimum wage increase. In a recent conversation with a client with multiple restaurant locations, he informed me that the bottom line was hit about $1,000 per month per store. It will be interesting to see if that tapers some of this restaurant expansion. So what does this all mean? 2014 saw a 6.6% increase in restaurant sales in the city of Sioux Falls. Part of that can be attributed to inflation, and part of that can be attributed to the population growth. But at the end of the day, we have some winners and losers. Who are some of the losers? Fast food. Long John Silver's closed, KFC closed the location, and we've heard recent national discussion, really global discussion, about some of the large fast food players and declining sales. Also, the frozen yogurt fad has come and gone, with several going dark in the last 12 months. And we've got another category, which includes La Fiesta Mexican, IHOP, That's a Pizza, etc. Some of the winners: the fast casual QSR restaurants like Qdoba and Pita Pit. Also, the health conscious, the neighborhood bars, and the unique concepts like MB Haskett and Parker's Bistro. Another trend to discuss is the evolution of retail. Moving forward, retail will be led by the 3 M's: mobile, metropolitan areas, and the millennial generation. Amazon is clearly the biggest player in this room. Amazon's online sales are larger than their next 12 competitors combined, which do include Walmart, Best Buy, Barnes & Noble, Staples, and 8 others. Google has also recently announced that they're going to enhance their shopping functionality on their website in an effort to compete with Amazon. And both Amazon and Google are toying with the idea of a 1-hour delivery service in the very near future. So what does this mean for national retailers? We've already heard that Radio Shack has filed bankruptcy and will close 2,600 locations, a few of those that are in Sioux Falls. Don't be surprised to see a few others, especially these big boxes, go dark, like Shopko, Kmart, Sears, JCPenney in 2015. Let's move on to conclusions and predictions. While vacancy is down, rental rates are up, corporate, national, franchisee interest is strong, and as I stated earlier, construction was down, which was primarily due to the new Walmart being kicked into 2015, which leads right into my predictions. We feel like new construction will be back up over 40 million, maybe even 50 million, which will primarily be led by that Walmart being constructed at 85th in Minnesota, some 41st Street redevelopment, and then a lot of momentum out in Dolly Farm with the Buffalo Wild Wings and a new strip mall being constructed in 2015. Also, as I previously stated, we predict that 1 or 2 of the big boxes will become available in 2015, and downtown retail will remain strong. So let's take a look at the real estate cycle. With decreased vacancy, rising rental rates, job expansion, we're clearly still in expansion in retail in 2014.
Hi, I'm Andy Anderson, and I'll be talking about the office market. We have seen consistent growth in the Sioux Falls office market over the past several years, which is really good news. The Sioux Falls office market consists of 13.6 million square feet. That includes both owner-occupied and tenant-occupied space. As I move forward, I only focus on the blue bar, which represents the 6.9 million square feet of tenant-occupied space, due to the fact that the yellow bar, which is owner-occupied, doesn't affect vacancy or rental rates. We divide the office market into 2 sectors. The first is the CBD or the Central Business District. We have seen a very slight uptick in the CBD's inventory of 0.7%, with a total of 2.3 million square feet. Now, that increase was not due to new construction. It was really due to conversions from owner-occupied space to now tenant-occupied space. One example of the conversion that we've seen was the former Traditions building, which is now a multi-tenant building. Our vacancy shot up in the CBD by 77,000 square feet. resulting in our vacancy rate going from 8.7% to now 11.9%. In addition to the Traditions Building, others that were contributors to that increase in vacancy were the Wells Fargo Building, adding 25,000 square feet, as well as the former IBM Building, or now the Pioneer Building, which is back on the market, adding 33,000 square feet. With such a big jump in vacancy, it is no surprise we had a negative net absorption of 59,000 square feet. Downtown is one of those sectors where one or two buildings, especially those with large footprints, can really skew the market. This slide may not feel good, but it is nice to have space available to offer to companies that may have an interest in coming downtown. Some predictions for the CBD. I think our inventory will continue to be stable, and if parking requirements can be met, then I think our absorption will only continue to go up, which will help increase our rental rates. Now let's move on to the suburban sector, which is everything excluding the downtown market. Last year I predicted some spec building, and we did see that along Western Avenue between 69th and 77th Street, helping to increase our inventory by 110,000 square feet, with a total of 4.6 million square feet. Our inventory increased and demand is still very strong, resulting in a positive net absorption of 122,000 square feet. We are still well below our average, however, and I think what we are seeing is a systematic shift in the usage of office space. Office sharing, working from home are all becoming more common practice. When we have high demand and positive net absorption, we see a drop in the vacancy rate. We are currently at the lowest we have been in 10 years. We went from 8.1% down to 7.5%. And some predictions for this sector. Without question, I think we'll see the inventory continue to increase. And with demand being as strong as it is, absorption will continue to go up, which will help push those rental rates up. Now let's look at things as a whole. This slide represents our citywide vacancy rate. The blue line, which is the Sioux Falls vacancy rate, went up. Now remember those two office buildings downtown? Those two buildings really helped to push up the citywide vacancy rate. We went from 8.3% to 9%. However, when you compare Sioux Falls to the yellow line, which is the national vacancy rate currently sitting at 17%, we are doing very, very well. I think some of this is due to a trend I spoke of last year. Office densification is continuing to affect those national markets much more significantly. We are seeing it on a local level as well, just not as dramatically. This slide represents our asking rental rates, net of all expenses. And as you can see, the Class A rental rates are continuing to go up. We have a range of $13 all the way to $17 a square foot, which is typically newer product that is being put on the market. And Class B and C space is still holding its own. Our range is from $8 a square foot to $11 a square foot. Since 2009, we have seen positive net absorption in both the CBD as well as the suburban sector. This year, 2014, is different. As I showed you earlier, there was a large amount of vacancy in the CBD, and when we combine that with the suburban sector, it offsets the positive net absorption, resulting in a smaller amount citywide. However, we are still positive. Our citywide office market predictions are, I predict we'll continue to see positive net absorption, which will help drive down vacancy and increase our rental rates. I do think we'll see some speculative building citywide, however, I do think it will be limited. So where does that put us on the real estate cycle? I think we are poised for growth and will continue to be in expansion for the next couple years.
In this section, we focus on multifamily, office, and retail sales to give a flavor of 2014 deal-making in owner-occupied and investment sales. We'll take a look at what happened last year, and we'll make some predictions about 2015. This is a chart of multifamily units built since 2004. Clearly, developers have built increasing number of units since 2010. Why? They are responding to favorable interest rates, continued low vacancy, and steady population growth in Sioux Falls. Note this yellow bar is the number of townhouse-style units. These units are largely built for leasing, However, some are sold as condos. We break these out for clarity. This chart tracks Sioux Falls multifamily vacancy in blue and national vacancy in yellow. Since mid-2011, Sioux Falls has enjoyed high occupancy rates. Why? 3 reasons: population growth, tightened lending requirements for home buyers, and changing attitude towards home ownership. This chart tracks total sales dollars in blue since 2005. The number in the blue bar tracks the number of transactions 4 units and above. The multifamily market moved sideways this year. The majority of sales were smaller properties, 25 years and older. 3 hurdles are keeping sales transactions down in spite of strong leasing fundamentals. 1. Capital gains. 2. Depreciation recapture. And 3. Lack of solid 1031 options. It simply feels good to own apartments, and there's few options to trade up with a 1031 exchange. Let's take a look at one of the newer and larger properties that did trade last year. This is a Southern Sioux Falls project, 54 units built in 2008, and this sold for roughly $4.3 million or a 7.6% cap rate. Let's take a look at one of those older and smaller projects. This is 28 units and several buildings. This traded at $1.2 million or an 8.4% cap rate. This next sale was 24 units built in the mid-80s. It traded at $1.2 million or a 6% cap rate. Sellers don't get excited about this 6% cap rate. It was mainly due to mismanagement and high expenses. The property sold based on a price per unit basis. Let's talk office. The blue bar on this slide represents sales dollars in office since 2005. This sales market was driven by mid-size owner-occupant deals with very few investment transactions. While this sales number may not look impressive, we were simply lacking a sales transaction like the $14 million Heather Ridge investment property that traded in 2013. Our first example in this section is DocuTap's former headquarters. Most of you know DocuTap moved downtown last year, and an owner-occupant bought this really nice northwestern Sioux Falls office building for $1.9 million, or roughly $125 a square foot. Next up is Homefield Plaza. A dentist purchased this 12,000 square foot building across the street from Lowe's for $1.34 million, or roughly $105 a square foot. The dentist plans to occupy the 4,000 square foot vacancy. This Southern Sioux Falls office building was one of the few investment transactions that traded last year. $1 million sale, roughly $100 a square foot, traded at an 8.7% cap rate. Retail clearly had a stellar year in both owner-occupied and investment transactions, making 2014 the best deal-making year on record in this asset class. The story of over 30% of these transactions occurred on Louise Avenue. An original developer and his partners took some profits off the table, taking advantage of strong retail fundamentals and motivated retail investors. Our first example is the World Market and Big Lots building. This sold at $4.55 million, or a 7.4% cap rate. Next up is the PetSmart building. This 40,000 square foot building sold for $7.7 million, or again, a 7.4% cap rate. Another Louise Avenue sale, the Chuck E. Cheese building, $4.8 million, or a 7.6% cap rate. Let's look at 2014 sales volume scorecard. Multifamily was down slightly, trading sideways. Office dropped but maintained vibrant deal flow, and retail had a hands-down stellar year. Moving forward, I predict 2015 will see substantial increases in multifamily due to increasingly motivated buyers. Office will extend its strength due to growing business profits and optimism, and retail will remain strong, but there's no way we will surpass last year's record. Based on what we're seeing with cap rates, In 2015, we can expect multifamily cap rates to remain in that 7 to 8% range, office between 7 and 8.5%, and the cap rates for retail will stay in that 7 to 8% range. In taking a look at our investment and commercial sales retail cycle, I place all three asset classes firmly in expansion mode.
For those of you who haven't seen this presentation in the past, I would like to offer the following. We define the industrial market as those properties used for manufacturing, warehousing, distribution, transportation, and contractor shop space. Our iMarket survey increased in size in 2014 by a handful of buildings, 12, which resulted in an overall increase of 300,000 square feet. The number of properties in the T market remained relatively unchanged, but the vacancy plummeted. I will touch on the why later. The owner-occupied anomaly continues in both markets, with Sioux Falls at a 70-30 split and T at an 80-20 split. I believe this trend will continue because of an unwillingness of developers to build spec space in the markets because of rental rates that they can achieve. The following group of slides is my iMarket report card. To set the stage, we began the year with 536,000 square feet of vacant space. That's 3.5% of the market. We were absorbing space at a rate of 3,000 square feet per day. That's an unbelievably tight market. The city reported a record number of building permits and dollars. They weren't spent in the iMarket though. When we plugged the dozen 2014 projects into the graph, the 2014 bar was less than half of 2013 and 50,000 square feet short of 2012. Not what we had visioned based upon the feel of the market. I know you wanted to see some pictures of pretty industrial buildings, so here you go. Abilene Machine built their new facility off of I-90 near Cliff Avenue. Extreme Heating built up in Granite Valley, and Speedy Delivery built over behind the new Walmart on the very northwest corner of town. Another factor that we consider is turnover of existing space. The turnover of existing space remains strong at 700,000 square feet in 2014, up ever so slightly from 2013. Another way of saying that is that when something came on the market, it almost immediately got gobbled up last year. When we add the vacancy that we started the year out with to the new construction to turnover of existing space, the lack of new construction comes back to haunt us again. We had a combined available space for the year of 2014 of 1.3 million square feet of space. The norm would be north of 1.7 million square feet and maybe even closer to 2 million square feet. On December 31st, 2014, we once again checked the market. We closed out 2014 in uncharted territory. That 276,000 square feet of vacancy figure out of the 15.6 million square feet of space is below 2%. Quick math tells us that net absorption came in this year right at 1.1 million square feet of space. Not a bad showing, but we question how long this can be sustained with such a short supply of product. This is how the 1.1 million square feet compares to previous years. There is still movement. Things are still happening. Previously vacant space did get absorbed, and existing space changed hands. Net absorption still remains strong for 2014. The pace that industrial buildings in the Sioux Falls market were being absorbed remained unchanged at 3,000 square feet per day. At that rate, if nothing new pops up, and there will be, High Rollers is building a new building, and their existing building will hit the market mid-year, and Semprenco, same thing. They're building right now, and their existing space should be on the market by mid-year also. And finally, National Republic, a booze warehouse, will be breaking ground early spring, and their existing space will come on the market in Q1 2016. But if nothing else pops up, and those buildings aside, we'll be out of space by the 4th of July. Let's take a look at some of the transactions that contributed to that net absorption number. A pair of industrial buildings owned by the Natchez estate were sold mid last year as an investment sale. In our opinion, the sale price paid was driven down as much as 20% because of short-term leases and low rental rates being paid. This sale involved a package delivery company building. After major renovations, it's now used as a brewery. You may have seen it in the news recently. This sale was above the average sale price per square foot. The property was nearly a perfect fit, and they were willing to pay a little more for the building because not as many improvement dollars needed to be spent. $12.50 to $98 is a huge range. If you throw out the outliers, the average sale price was $42 per square foot. That is a 10% increase over last year. Here's some industrial lease intel. The tenant in this property renewed their lease for 6 years, right at the new average rent rate of $5 per square foot. Here's an example of a lease that came in above average price. It was a good fit for the tenant, and the landlord was just a really tough negotiator. There are a couple of takeaways from this graph. The attacks that occurred on 9/11 and the economic disaster that occurred in 2007-2008 both caused the rental rates to drop $1 to $1.25 per square foot. You can see that it takes a long time to recover from that. Secondly, the $5 rental rate remains a roadblock, and here's why. The $5 rental rate today, yes, that is a net number with the tenant paying taxes, insurance, etc., but you still have to put away money for replacement, management, professional fees, and my favorite, commissions. That leaves $4. To an investor looking for an 8% return, that $4 worth of income equates to an all-in construction cost of about $50 per square foot. That's just not going to happen. One of the brokers in my office keeps asking, well, what rental rate do we have to get to? My prediction, about $7 per square foot. I mentioned at the beginning of this report that the vacancy in the T market dropped from 7.1% to 2.5%. Why? Because that market had capacity. It wasn't just T. It was Harrisburg, it was Hartford, and as far south as Canton. Users went where there was space available. Following are my conclusions and predictions. First off, the surrounding communities will continue to experience growth. Of the $50 all-in construction number I just mentioned, $12.50 to $15 is land cost. Some communities have really cheap land and even free land, and it's really tough to compete with free. I think the lack of construction that we saw in 2014 will change slightly with an uptick in 2015. We are seeing some larger users looking at Sioux Falls. We don't have anything to offer them right now, but I think we will here shortly. As I mentioned, the High Roller building and several others. And For 2015-16, I'd like to lay down a challenge, and that is to figure out a way to provide cheap land to offset the cheap land in surrounding communities and even free land.